As you have been, as usual, saying lots of interesting things about the economy and monetary policy. And just recently, you said you think it's best now to leave rates where they are. Earlier in the year, you were a little more willing to say maybe another rate hike, but now you say no. Low unemployment's not going to lead to higher inflation. It's surprised to the downside. We're stuck in the St. Louis Fed's low growth regime. But Jim, jobs keep growing. You know, unemployment, the GDP has rebounded. It's above trend again, and some people think it's going to stay there. Maybe not. Is one more rate hike this year a problem?
Yeah, I think the FOMC's been surprised by inflation coming into the downside during the spring here, and not by just tiny amounts, really kind of by a large amount compared to the progress that we made through 2015 and 2016. So if you look at the charts, we were creeping up toward 2% all during 2015, 2016, and in 2017, most of that progress has been undone. And I think that's, at least in my mind, leading to a reevaluation of our story about whether, you know, our policy is leading inflation back toward target or not, and so we'll have to see how the data comes in the second half of the year on that.
So are you just saying then let's just wait for the data, and if it's stronger by the end of the year, I'd be in favor of a rate hike?
Well, I'm willing to. Of course, we're always data dependent. I'm not too optimistic that we're going to have higher inflation measured on a year-over-year basis by the end of the year. If you look at the SEP, I think we're still predicting about 1.6%. For core inflation by the end of the year, and so we'd still be sort of well below target and not too far from where we've been in the last couple of years. So I think we've got a ways to go here on inflation. Well,
but if inflation's not responding much at this point, and it's a good idea to normalize, to move the funds rate up, what's the harm? Is it going to tell the economy into recession?
What you'd be doing is you'd be moving preemptively against future inflation by moving the policy rate now. We've already moved the policy rate 3 times. Why do you need to do that in this environment? You've got low inflation in the U.S., you've got inflation expectations measured by markets below where you'd like them to be. You've got other countries with low inflation rates in the developed world. It just doesn't seem like an inflationary environment where this is going to get away from us, and so I think you don't need to be preemptive in this situation.
Is there a risk that this undermines the U.S. economy, that it undermines growth?
The low inflation?
No. If the Fed does raise rates at this time, if the Fed does move preemptively, as you would call it, and goes ahead and says, well, we want to get that one more rate hike in this year, and maybe even next year does some more. You don't really see the need for rate hikes till 2019. What's the risk of that? Does it hurt the economy? Does it maybe cause a recession? I think there is some risk that the committee could be too aggressive in this situation and damage growth a little bit. So I wouldn't say it's a huge risk at this point, but it's something to consider. Well, you know, I want to come back to this point because inflation has missed the Fed's target for, what out of the past 5 years, all but 1 month. And if you look at the 20 years before, even then, inflation was just roughly moving around 2% if you look at 5 years averaged. So it seems like things have changed. So at this point, why is the Fed broadly still on a rate hiking path? Is this the right Fed monetary path for now? Or should the Fed be looking at this and saying, maybe it's time just to get off of it?
Well, they should be listening to me. We're in a low growth regime with low interest rates and low inflation. It's not just the U.S., really the G7. And I just don't think in this environment that you have to really push hard to get back to some level of interest rates that would have been appropriate in an earlier era, but that's not the era that we're in right now. So I think we're actually in pretty good shape for rates right now. We can leave them where they are and then see how the data develops.
Any sense with your colleagues on the Federal Market Committee that you're starting to make headway, that people are seriously looking at this the way you are and starting to reevaluate whether they really should even be talking about doing more rate hikes while inflation stays so low?
Well, I hope so. I mean, you can ask others on the committee, but I think the idea that there's a lot of growth just around the corner in the U.S. Is probably not the right model to have in mind. I know there are attempts in Washington to push up the growth rate. I applaud that. I think that's a good agenda to have, but so far, not too much has been implemented, and even if it was, it would take a while to have an effect, probably at the earliest now, second half of 2018, even into 2019. So from a monetary policy perspective, where we're thinking in terms of 18 months or 2 years, we're probably not going to move too far off the 2% growth path during that time frame. And so for that reason, I think it's wise just to stand pat on rates for now, anyway.
Okay. Well, it's because so you stand pat on rates, but full speed ahead on the balance sheet unwind, getting that started. You said September. Now, I want to ask you this, because for the longest time, remember when the Fed stopped buying bonds, it, but we're still stimulative. We've got this really big balance sheet, and the mere presence of a big balance sheet is stimulative. So great, we get that. But now the Fed's going to let it shrink. You're removing accommodation. That's less stimulus. I guess you could call it a tighter policy over time. So why are you in favor of balance sheet unwind, reducing that stimulus, but against a rate hike?
Well, if you recall, I've been for, I actually would have started reducing the balance sheet first and then raise interest rates later. And the committee didn't do that, but this year we managed to get the discussion going, and we've come up, I think, with a good plan for how to reduce the size of the balance sheet. It is so incremental and so slow initially that it's almost nothing, and you're starting from zero, and then you're just barely rolling forward over the next year or so. And so I think that's a very prudent way to go about this, and I think it's also, you can create some policy space on the balance sheet for the future. If you ever needed to go back to balance sheet policy in the future, you should be reducing the size of the balance sheet during relatively good times and allowing that policy space to develop going forward. So I think it's a good approach. If we go ahead and do it in September, it will be almost negligible initially, and then we'll build up over quite a bit of time.
Well, but you do build up, and it does get pretty substantial. So basically you're saying a little bit of tightening via the balance sheet the economy can take. That's fine.
Yeah, I mean, come on. If some of these estimates are 25 basis points over 2 years. That's 1 basis point per month. What is that compared to the volatility in bond markets?
Okay, fair enough. Another question on this, though. Remember when the Fed said that the balance sheet unwind would start when normalization was well underway? Do you think we've got about 100 basis points of rate hikes, right? Is that an adequate rate buffer for starting the unwind at this point? I know it's going to be gradual and not disruptive, but what if everything doesn't go, if everything goes pear-shaped? Maybe 100 basis points, right? I think we're referring to the dot plots, right? Okay. Boom, comes down. You don't have an adequate buffer. That's what a lot of people might say.
Yeah, Chair Yellen gave a speech at Jackson Hole on this topic, and she did talk about how the Fed would react to a future recession if one developed. There's no recession on the horizon today, but you never know. So her argument was that we did have enough ammunition to handle a recession going forward. It would probably be to reduce the policy rate back down to zero and then consider quantitative easing at that point. And for that reason, I think you'd want to develop policy space both in terms of interest rates and in terms of the balance sheet, so that you felt like you could make moves if you had to at some point in the future. Okay,
so in other words, you're saying maybe it's only 100 basis points on the Fed funds rate, but don't worry about it. Once we get to zero, we'll just do quantitative easing again.
Well, I think that's the reality of the era we're living in. Yeah.
Yeah. Okay. Alrighty. I want to ask you about the dollar.
You could do forward guidance and some of the other things that we've done.
Do you think forward guidance is all that effective? I mean.
Well, it remains controversial, but some of the studies say it was pretty effective, so it's hard to say. But I think if we got back into that situation, all those debates would reignite again. We're not really going in that direction right now. We're going the other way right now, but this is just in contingency planning for the future.
Is it possible that the Fed funds rate doesn't move much more from here for a long time? Is that basically what you're saying, that we're kind of at the neutral rate? We're kind of almost where that because of this new economy we're in?
I think if you continue at a 2% growth rate economy and you continue at a sub 2% inflation rate and inflation expectations remain as low as they are based on market measures, you know, I would not see the policy rate moving very much off of where we are today.
The dollar's down 8% this year. You know, I know economies have improved overseas, and people are waiting for more central banks to get more hawkish. But you look at it, the Fed, the ECB, the Bank of Japan are all having the same problem. Inflation is not cooperating. They're trying very hard to boost it and not getting it there. So I wonder, since that is a commonality, does the weak dollar make sense to you, and do you expect it to keep falling? What do you see with this whole dollar?
Yeah, it does make sense to me. I think mainly what's happened in 2017, first of all, the dollar had a big run before that, beginning in the middle of 2014. So this is only retracing some of the previous strength in the dollar. The other thing is that during 2017, on this side of the Atlantic, we had the weak inflation numbers. On the other side of the Atlantic, they had relatively good growth numbers, and they're pretty happy, actually, about the growth prospects in Europe compared to what they were expecting coming into 2017. So naturally, a stronger European economy and weaker inflation numbers in the U.S. is leading to a stronger euro and a weaker dollar.
Will that help inflation much, the weaker dollar?
Actually, I don't think it passes through all that much, at least not through direct trade channels. I wouldn't expect a big effect there.
Okay. Well, this could have a big effect. President Trump is reviewing his choices for Fed chair. And from someone who's been in the Federal Reserve System for so long, what should the president be looking for? Is it important to have a PhD economist? Is it important to have someone with central banking experience? Some people have said there's too many academics at the Fed. So let's get some market people in there. What should President Trump be looking for?
Well, I mean, it's up to him to make the call. Of course, I like PhD economists. I like research. That's the kind of style I'm used to. But I also think a wide variety of voices on the FOMC is beneficial. We've certainly benefited from having people with different backgrounds on the FOMC. I think also because it's a big committee, you get a lot of stability through that process because people are coming and going all the time, but it gives you a lot of continuity. You have some people that have served for quite a while, like me and others on the committee, and that gives you institutional memory that you can carry forward. You've also got a very good staff in the Fed, both at the banks, like you just talked to, but also at the board, and that gives you a lot of continuity as well. So I think there's, those are some of the considerations when you think about the Fed versus maybe some other agencies.
Okay. Do you think that it is maybe time, though, for something where we have more diversity in terms of people who know markets, people who have experience with that?
Whoever it is and whatever background they come from, they're going to have to know monetary policy, and they're going to have to spend a lot of time thinking about, quantitative easing and R-star and all these issues, and this is kind of life inside the central bank and within financial markets, the part of financial markets that follows the central bank. So I think there's no getting away from that, and there's because these are the core issues, and the theories are not as good as you probably like them to be, and for that reason we got to make decisions under uncertainty about what the right model really is, and hopefully we can get good outcomes through that process.